Well, on a cross-asset basis, we've seen the S&P futures pushing 6,000 once again, and once again rejecting that level. Will we see the sellers look to dominate? We saw the NASDAQ futures pushing 22,000, but it seems with the rollover in Tesla and Nvidia that the market may be looking to push this one low. We'll obviously have to see what happens with non-farm payrolls in the session ahead. Now, of course, the US dollar has been universally weak of late, and there's been some growing calls that we may see another 10, 15% further falls coming through in the US dollar on a purchasing power parity basis, real effective exchange rate basis. But certainly we'll look at the US dollar trade, and we look at trades that we like around that sort of complex. We're also looking at gold, ranges within ranges. We're also looking at Bitcoin and how that may play out. And of course, we have to dissect this relationship breakup, the bromance breakup between Musk and Trump. It's got legs. We'll see what happens there. This is the trade-off. Hi there, my name is Chris Weston, Head of Research at Pepperstone, and I'm being joined in 2 seconds by Blake Morrow from Forex Analytics. And we will be discussing all the factors that are going on in these markets, the technical setups, the news, the movers and shakers and trades that we think directionally could make sense in this market. Mr. Blake Morrow, we've seen a formal split up, between Trump and Musk. That same dynamic will never happen between us. We'll always be bromance. Will always be real, buddy. We'll dissect it in a second, but yeah, I mean it's amazing to see how this sort of transcends. I think it's captured pulled the attention away from Trump and Xi, and sort of where does this all go in the short term? So yeah, how much have you been watching that?
Oh, well, of course I've been watching it. I mean, how can you not watch it? It's front and center. It's a little bit of a kabuki theater from our part and our point of view, but I know we're going to have a little bit of a discussion about it today and how it's going to affect markets. But I'll tell you, Chris, it's coming from my country.
I want to discuss that in a second, but another quick question before we go into topical thunder is this idea that we have seen tighter ranges coming through in markets. How much are you now sort of thinking to yourself, you know what, it could be the time now just to sort of maybe ease back? We're coming into summer season. Now, you're talking to your trader friends, your buddies in the Forex Analytics community. How much is this summer sort of situation, poor, lower liquidity, the tighter ranges, less sort of impactful markets? Are you seeing that situation? People shutting up shop and calling it a summer?
Selling may go away, Chris, and
That's right.
that's about where we're at right now. We're in the May range, even though it's the beginning of June, and this year might make more sense than any year. I mean, you talk about a fiscal spending bill, which may or may not hit the Trump administration's desk by maybe the end of summer. Markets are going to get worried before then. You've got obviously a trade war that's ongoing. You have China and U.S. trade talks that might be starting. Maybe they're not. EU, same thing. This might not be a bad time, Chris. And so if you ask, are we having those conversations? Absolutely, we are.
Good stuff. Well, low volatility is boring, isn't it? So let's hope that the market shows some life. We'll have to see. Anyway, let's go into topical thunder and discuss those very thematics. Well, it is the topic du jour, and it has been brewing, and it may have legs and it may fizzle out. We'll obviously have to see how it goes, but it has turned a little bit nasty. I mean, obviously, Musk has pretty much proclaimed that Trump won the election because of him, and I guess on that grounds, his approval rating could get pretty much smashed up on this situation. I think Musk has taken this one further, posting about his involvement or potential previous involvement. I think they're unsubstantiated, of course, on the Epstein list, and that's pretty powerful stuff. The way obviously we've seen the Tesla share price reaction. It was down nearly 15%. In the options market, we saw 4 times the amount of put options on the day that we would typically see. So there's obviously a lot of activity, people sort of selling first and asking questions later about what this all means. And I think for Tesla shareholders, you've got this idea of, you had obviously the brand damage on an international basis by having, Musk so involved in the administration, and obviously international sales have taken a hit on the back of that. He then leaves Doge, and he puts all his efforts back into Tesla and the businesses, and then he takes on the president in a very real spat. So it's getting nasty. Feels like there's more to go in this. He's saying that the US could default, and that the big beautiful spending bill is an abomination, and saying all these other factors. And now shareholders are probably sitting there going, just be quiet, don't take on the president of the United States. But this is the way that Musk works, isn't it? And he's obviously hurting. So now they're having to deal with this. I feel like maybe 15% may be overdone, but they're also getting hit because of the Senate is debating the big beautiful bill, which impacts their earnings anyway, because there's going to be changes to the EV credits that are coming through, so that's going to have a big hit to earnings anyway. But how does this work? I mean, do you feel like Trump has to tread a pretty tight line here because of the influence that Musk could have on approval rating going into next year's midterms? How do you see this dynamic playing out?
Well, I do think he has to tread carefully. And, I've heard all these analogies the last 24 hours, from two tarantulas to two, I was going to say two goldfish, two piranhas. But, fact of the matter is, two apex predators are like really in the ring with one another. And they really, both of them have a lot at stake, whether you're talking about, Donald Trump and trying to get this bill passed, and is he going to get the support of these other lawmakers, especially knowing that such an influential person, like you could say these are two of the top most influential people in the United States, perhaps maybe even in the world. I would argue they're at least in the top 10. And you start looking around and going, man, both of them, you saw Tesla got absolutely destroyed. I know you're saying post-market, it bounced a little bit, but Tesla's getting destroyed. Trump coin's getting destroyed. Dogecoin has nothing to do with anything other than it shares the same name as Doge, and Doge that Trump was doing, or that Musk was doing, it Dogecoin that does nothing anyway. But that was getting hit. I mean, you name it, the markets are taking notice, and I think so. When you're talking about Elon Musk, yeah, he's got Tesla and his reputation, and the
SpaceX as well, government,
SpaceX, all the contracts,
funding.
Funding. I mean, and then you got Donald Trump that's really trying to push his agenda that's going to have a very difficult time. But you got two apex predators face to face wanting to rip each other's heads off. So I'm going to get my popcorn. I like cheddar cheese, white cheddar topping on it. Really good. I'm going to sit back and kind of enjoy the show a little bit.
I think at the moment it's very much a Tesla story. And I think Musk is looking to potentially IPO the AIX, or whatever it's called. The X platform, I think, which could be quite interesting in itself. But the question I'm asking, and interesting for people at home as well, because it's obviously just breaking, and well, it's not breaking, but it's we're still exploring the concepts around here. But at the moment, it feels like it's confined very much to a Tesla story. But I question, does this have legs in terms of, does it become more of a broader market story because it has an impact on, the big beautiful bill and Musk really going after that? Does it have something to do with the Senate and the House for 2026? Musk could really go after that. Or is there a natural handbrake, because the harder Musk goes on trying to do that, the more the President Trump could really look to stamp, to come back on that. So the question is it's still very much in the unknown. We're trying to price risk around this. It feels like it's more of a Tesla story at the moment, but does this become something a bit more of a sort of multi-asset global macro story? That's the question.
It could, and I know we need to move on, but it's one of those things that, when you're talking about your initial question before we jumped into topical thunder, it's like, are there reasons that we should be a little wary with risk right now? I think this could be the snowball effect, something that could actually kickstart a little bit of risk aversion. When people start taking a step back and saying, you know what, I've had a good year. I've had a good 6 months. We've had a nice bounce back. I've recovered a lot from our 20%, sell off. Those types of things have to be on top of mind, as you in Westy's words, top of mind for a lot of traders and investors globally. So Anyway, it's going to be really interesting to watch, like I said, and I think the way the market reacted as soon as that news was out, as soon as Musk said he's on the Epstein list or Epstein files, as soon as the market reacted from after that, you see the market sensitivity. But you know what? It's also sensitive to is in two topics we're going to get to NFP. It was sensitive to the ADP data that came out earlier this week, but we're going to get to that after we talk about the most unimportant story circling right now is the China US trade negotiations. Wait, that happens to be the most important story that was overshadowed today by Donald Trump and Elon Musk. So we should probably discuss what is happening with China. Now, there was I'm going to read you a couple of the headlines here from some of the news services, but Trump apparently this is according to the Trump administration or according to Xinhua, the Chinese news agency, said that Trump actually requested the phone call. But China Xi says President Trump is welcome to visit China again at any time. Xi also told Trump both sides should increase exchanges in military law enforcement. Xi and Trump agree to start a new round of talks as soon as possible. That's probably regarding all of the precious the rare earth minerals and stuff. And dialogue and cooperation are only the right choice for China and the U.S. And so there's a lot of good, positive headlines that came out of that. Now, we heard from both sides, which is good. Now, in all actuality, this should have been the catalyst, in my opinion, that would have taken the S&P above 6,000. And I gotta stop and ask you, Westy, why didn't we catch a bid on this optimistic first talk between China and the U.S.? What do you think here?
Well, I think we were only ever going to really hear positives, constructive call, good call, that sort of stuff. I mean, I think
Of course.
Trump had come out in the previous session and say, look, it's really hard to deal with Xi and China and getting a deal is they're hard to deal with. So we kind of we're getting one told that, and I think that feels fair. He's obviously got to come back to the US electorate and make out that he's pushing for the hardest bid, and the Chinese will be saying exactly the same thing back to their population as well. It's about the art of the deal in this situation. But I think our market's really expecting this to lead to an actual deal. No, absolutely not. I mean, are we looking at a situation on 9th of July? Obviously, we've got to see what happens through the Court of Appeals and the lower court. And that decision won't be coming anytime soon. But like we look at the deadline for Chinese tariffs, which is not until August. Actually, the 10% reciprocal on every other country is the 9th of July. 9th of July, but for China in August, what do we expect? We expect them to roll that over. The starting points between China and the US are so far apart that they're talking to each other great. But are we actually going to see a full blown agreement in August? Absolutely not. Are we likely to see that deadline being rolled over? Absolutely, I think, and that's kind of what we're expecting. So I think the market is looking at that. If Trump throws a wobbly, and I guess the more annoyed he gets through the Musk situation, the more prone we are to something punchy coming out and him sort of moving away from his communication specialists, experts, and breaking loose. And that's a concern for us, right? Going into the weekend now, because the script has changed under a Trump situation, and the more angry he gets, the more likely over the weekend he is to come out with some pretty punchy rhetoric and having a gapping situation, a risk-off situation, or a gapping situation on the Monday Open. But I think all we condition for is it's positive that they are actually talking to each other on phone calls. They're obviously all going to make out that the calls were constructive, and they're pushing. Both parties are pushing for the best part. But are we going to get a formal trade agreement in August? Unlikely, very, very, very unlikely. These things take a long time. Are we likely to see it rolled over or pushed back? Yes. You're not going to see tariffs going up to 145% in China again. Did you see the import numbers last night in the US? The trade data numbers, biggest collapse we've seen in US imports ever. and that was obviously down to the fact that what we saw in China. Now they're just not going to go back up to 145% unless something really dramatically goes wrong. So yeah, I think we're just expecting that to roll over again. Anyway, Blake, I want to go into NFP because you brought up the point about ADP, and obviously everyone sort of comes out and says, look, it's been the worst predictor of payrolls numbers. So why should we look at such a weak ADP number and say this is going to be a precursor for non-farm payrolls numbers? Now, we can also look at the rise in continuing claims, which does have some sort of relationship with the unemployment rate. We can have a look at the jobless claims last night, which also moved a little bit higher, and we can also look at other sort of leading indicators. But I say that, we look at consensus, 126,000 on the payrolls number, unemployment rate of 4.2%. The trend over the last year has been, if we're going to see an outlier print, it's always been higher, typically been higher. So for me, pricing risk around this event is very, very difficult to do because the leading indicators have been so poor. The outliers have largely been to the top side. So, we just got to go along with where the conviction is. But how are you seeing? Where do you see the balance of risks, and where do you see a big move in the dollar or in risk assets from the outcome?
Well, I think first of all, the dollar's at risk, and I think this is the month that we are at the highest level of risk of starting to see the data show a lot of weakness. And just so you know, going back to your comments regarding the ADP, you are aware, and our listeners are aware, and everybody here should be aware that a broken watch or a broken clock is still right twice a day, not once a day, twice a day. So even if ADP has been off for so long, you're right. You're looking at private data versus the BLS data. You're right, but sometimes, and guess what? Sometimes the trends actually do coincide with one another when you're talking jobs data blanket across the board. But I think that is right now the risk is that we just are starting to see job losses, that the market was pretty, analysts might have been a little sleepy at the wheel. And we've had unemployment claims that have been steady below 250,000 or around 250,000 for eons, maybe years. And I think that we are going to start to see this could be the jobs report that really does impact the market. Going back to our earlier conversations, Chris, this market needs an excuse. And I think that's the risk, the excuse of, oh, there's a big tussle between Trump and Musk. Oh, China and the US, this is a long road ahead. Oh, wait, the jobs report, it's not very good, or it wasn't as good as we had hoped. And those three things alone, we could actually see some selling of risk. And I think that is, and I think the dollar is already on its back heels.
I'll take the other side of that because I do agree that there's a reason why the S&P is at 6,000, and I think that's because the unemployment rate's been so low that we haven't seen the fragility in the labour market that some people have been anticipating. That's been pushed back because tariffs have been put on pause, and they're collecting tariff rates at the moment, but it's still well lower than where we were, and that sort of impact is going to, once it actually fully goes through, when businesses actually fully understand the tariff situation, and that won't be really fully known for a while, then the labour market will truly cool towards the back end of the year, and people have pushed those recession bets out longer term. But there's a reason, and that's because the unemployment rate, I think, is absolutely key to the whole picture at the moment. So if there's any fragility, I agree. If it comes out 4.4%, market comes down pretty hard. But we've still got 50 odd basis points of cuts by the end of the year. And it feels to me that the Fed at this point are more likely to cut by one than the 3 rate cuts. So if we got two cuts priced in for the end of the year, I would say, the market is probably leaning. If we're going to get anything, it's going to be 1 cut, 25 basis points, and not 3 cuts. So I think, if we get a strong number, like a 200,000 number, an outlier print, and the unemployment rate was to say hypothetically trickle down to 4.1%, those rate cuts come out and the market says, well, we'll really get 2 cuts. And then obviously that short dollar positioning comes out. And that's a risk as well. So that's, I think, market is short of dollars in a speculative sense, short term. But the big picture is that the world is still very, very, very long of US dollars. in its investments, and those hedging ratios will come down over time. So, or increase over time. So I think, yeah, short term, there's a lot of specky accounts which are short the dollar at the moment, but I still think the big picture, where real money accounts and corporates, pension fund entities are so long of US dollars, and that still has a long way to go. So I think that's a big sort of dichotomy.
Yeah, it sure is. All right. Well, Chris. Speaking of which, I'm glad we're talking about this because we're going to go shift right to the last topic, and we're going to talk about just the markets in general. You could single out, European markets are at their highs. A lot of them. I mean, maybe not the CAC 40, but you take like the German DAX is still high. Spanish markets high. The IBEX. You got the S&Ps near 6,000. And really, since the middle or since last month, we've been stuck in a pretty tight range, believe it or not. You look at the S&P, we don't have much, but maybe a couple percentage point range, really tight. So I guess what I'm looking in the future for, let's just say we get past the jobs report. Let's say it comes in, not too warm, not too cold. The porridge is just right. If you talk Three Little Bears, and we see the markets still kind of hovering around the 6,000 mark going into next week. What is going to be the next driver that we're going to be looking for? I mean, what's going to be what pushes us to new all-time highs? We have inflation data coming in next week. Is that going to be the driver? Is it going to be the Fed? I mean, the Fed's in neutral. I don't know what's going to get them out of neutral at this point. I mean, if the jobs are steady, but inflation, let's say, is still rather sticky, and they're still waiting to see what happens with China and the U.S., I don't think the Fed's going to be much of a catalyst. Or is it, maybe the bond market? People start to get a little freaked out with fixed income, and you start to see some auction failures again. I don't know. And that's why I want you to look ahead and tell us, Chris, do you think is going to be one of the key drivers moving forward?
Well, I think the reaction to the ADP numbers and the ISM services numbers earlier in the week was pretty interesting, and I think the market showed that bonds actually worked as a defensive vehicle for the first time in a long time. People were so worried about term premium blow-ups and inflation expectations, but we saw that weakening, and I think there is a perception that the growth longer term is what is more concerning than the inflation picture, and that sort of trades the role there. But all of the above, really. I think it could be anything. And when the market expresses a thematic and clearly sees it in the price action of the bond market, and we can see how it's most sensitive to, then it will reveal itself. But we at the moment, I think we're in a holding pattern for a reason. We've liked equity because margins are expected to increase. Earnings revisions have been hotter than downgrades. There's all these tailwinds. Positioning is rich in equities from CTAs, but it's not outrageous. And so we've liked the story, and we've had to be open-minded about why we're up here. But the price will tell you what could happen. So it could be inflation. It could be the unemployment, the labour market. It could be something that people say there's going to be real conjecture about getting through the big, beautiful bill through the Senate. We saw it pass with ease through the House. But will the Senate become much more problematic? It will be. And I think it's going to be a mess, to be honest. I don't think it's going to be. I think Trump's going to have to really go hard with trying to corral the senators, because there's going to be a lot of pushback around some certain parts. I think there's about 114 provisions in it. It's not going to be smooth passage, and it's not going to be pushed through by the 4th of July, which, of course, is what they want when they want to get it done. And obviously then the debt ceiling becomes an issue. We know how that ends, but it's going to be a noise fest, as we always know. So look, there's a lot of things, but until price actually responds either in the dollar or in the rates market, and volatility kicks up, we see the VIX above 25%. It's a question of having a shopping list, identifying all these different risks, and waiting for the market to show its hand, which one it's sensitive to. At the moment, it could be any of them. It's not clear.
Good. Yeah. And I'm not getting a lot of clarity either. And that's why I wanted to pose this question. And just for the record, before we move on to that's a setup, Chris, I have to admit, you came out here on the trade-off show. You're like, get used to the word or the phrase term premium, get to know it, learn it, love it. And guess what? All the financial media outlets were using term premium within days of you saying that. I know there's a lot of smart people that watch this show. They cue into what you're saying. So kudos to you guys for watching and paying attention to what Chris has to
Yeah, I
say.
think that's. I mean, that sort of fear has settled down a little bit. It became a big issue when we saw term premium, which for people out there aren't familiar and didn't watch that show, it's basically the cost. If you're going to go and lend the U.S. government money for 10 years, effectively you're saying, well, why would I do that? Why would I lend money to the U.S. government for 10 years and receive the sort of semi-annual coupons in the principal and interest back on maturity? Why would I not just get a 1 year bill and just roll it over for 10 years straight? And then I don't have, you're gonna have to compensate me for liquidity issues, for inflation risk, and all those other factors. So the term premium is essentially the compensation that bond markets want for holding that longer term paper, as opposed to simply rolling over the short term debt and having that. And that's gone up to about 1%, which is a big part of the yield that you see in the long end. So the higher that is, the more negative that is for risk assets, because people are saying there's big risks around holding long end. And I think markets are able to absorb a higher 10-year treasury as long as it's built on better growth expectations, and then because earnings go up as well. But if it's done by term premium and inflation going up, people are saying, well, that's not good, and that typically becomes a headwind for equity markets. So yeah, I think we're off the ball now. But obviously, I think with the Senate situation, it's something that Musk is really clear to push. That term premium situation could come back in. Anyway, moving on. That's a setup. Right, let's go to the S&P 500. Obviously you can see there, obviously the wedge that didn't really manifest and play out. We were looking for, potentially to see what happened. That has been absorbed, and what's actually really clear now is that we have gone into a bit of a range. We did try and break that 6,000. I think it's three times we tried to break that level, and every time the sellers have pushed in. It's not really been an emphatic sell-off. Like when you see breakouts or test the breakouts, obviously you're looking for that massive range expansion, the volume to kick in, and just say that it's an outright rejection. We haven't necessarily seen that yet. So we are still in a bit of a holding pattern, and these markets are for range trading. But this low volatility. And it's a great one with another talking point below, which we won't go there. But this lower volatility is seeing people going into income. So people want income and carry. They're seeing that in the Brazilian real. You're seeing that in the LATAM FX, and using the US dollar as a funder because they've got much higher relative rates. But this grind sideways, this low vol environment that we're seeing on a crash asset basis, it's why the ASX is outperforming, because you got such a high yield and both dividend yield and earnings yield there. But can we break 6,000, or is this the rejection for the third time, which could be meaningful and take us back down to the neckline of the head and shoulders pattern, and then potentially close the gap? This is a setup that needs obviously monitoring. If you're looking to short, where your risk is. You have to see a close above that end of the range to take the loss on that one. But this is one that obviously is getting a lot of attention right now.
As it should, Chris. And I'll tell you, I've been aching for a move back down to 5,500 to play it on the long side, near the 200 DMA. Kind of hoping we do hold this and give us a dip, so us dip buyers can really step in, on a more meaningful dip, rather than just trying to.
It's hard to. I mean, it's one of those things you always talk about here, Blake. But it's 6,000. It's really hard to chase this market high because the risk reward just isn't there. But until you see the volatility kick up and people really looking to hedge out that exposure and the bid drawing out this market, it's really tough to short as well.
It really is. It really is, and every dip gets bought too. So very tricky pivotal area. Thanks for bringing that up. My first setup is going to be the dollar CAD. It's the loonie. Now I want you to really focus on this one for tomorrow. Hopefully you guys, I know you guys have a huge Asia population of viewership that watches this show. I hope you guys are going to stay up for this jobs report. I do think it's probably I know everybody says it's the most important jobs report that we've seen in eons, but I actually believe that this could be a big mover. And the dollar Canadian has already set the stage for what we might get tomorrow. So the reason why I call this as a setup is because we are below I think that's a 4-year trend line, and we're below the 78% retracement, which is a big deal for me. That means the fact that we're consolidating below 137 already gives it a bearish slant. So what we need tomorrow is and I'm not sure how we're going to get it, but we would need a weaker US jobs report and a not so weak, at least a not so weak Canadian jobs report. And this could be one of those situations when you get a weaker US and a stronger Canadian jobs report, if that truly is the case going into tomorrow, this is one of those situations where by the end of the day, you could see this drift lower as people just start hitting the bid, because you're not going to get a false breakdown. Now, the flip side is if we get back above 137, it is a false breakdown and you're probably going to get a squeeze. That would be on the result of a weaker Canadian jobs report, stronger US jobs report. It is a setup, and I think it's live, and it's something that I'm looking to trade aggressively.
You've been all over this one as well. I think this is one that you've been talking about quite liberally and on the right side of that one as well. So yeah, kudos there. But yeah, I mean, there was a massive trend in place. So I'm sure this is going to get quite a lot of attention, both technically and the way that the price action is set up, and obviously from the tactical sort of fundamental picture that you bring up there. So yeah, a really interesting one. I want to bring up gold because gold's you can see that from the orange horizontal lines that we've got, obviously a big range in play, a big primary range from the double top, down to the recent lows that we saw. But we do seem to be sort of carving out a bit of a range, 32.83, 33.90 in the short term, and that's kind of defined by the sort of the black horizontal lines that we've been seeing there as well. So, this is one that sort of you just sort of get an opinion changes. What are we missing? What are we looking at? Market sort of doesn't know so sure, so we sort of go sideways, and then people find some sort of new buying, typically from China, and then it sort of makes a move higher as well. So this is a tough one to trade. You have to sort of look at the price action, look at the ranges, and sort of respect those ranges, fading markets into the top, and then obviously looking to buy into the bottom, and then we sort of take a level down. But we've got a well-defined primary levels which to work with. So obviously if we go into those closing highs at the top orange line, if closing the break above that would be very significant. That would see us potentially taking another bull trend higher. The bottom ones, the bottom orange line is obviously a clear primary low. I think we let those levels hold until we know some more news, and obviously we have to see what happens with the dollar. But one thing's for sure, Blake, every day around 11 a.m. Eastern Standard Time, Australian time, we saw the Shanghai futures market open. We see the Chinese gold ETF market open, and the buying steps in. So there has been a trend. Whilst the gold market is looking very closely at the US dollar at the moment, that relationship has picked up sharply on a reverse basis. The Chinese are coming in at 11 o'clock, and they're buying gold, and that's really been supporting the price and any weakness there.
And it really has over the last couple of days. I have a couple of people in our community that are constantly buying gold on the Asian Open, and it hadn't worked for a couple of weeks, but man, the last few days buyers have been stepping in. So
Yeah.
great tidbit of information there. Good nugget, we call it.
Good nugget.
Speaking of a nugget, your digital nugget, let's talk about Bitcoin. And I'm bringing this up because I'm giving a little bit to the bulls and to the bears. And believe it or not, I think right now we have a bearish setup. It's a head and shoulder pattern. It actually points, that is what we call a complex head and shoulder pattern, slanted neckline. The target, if we complete, takes us all the way below the 200 DMA, or around the 200 DMA, but it's also the 50% retracement. So that means it's a 50%, it's not a Fibonacci level. So for those of you that are tech Bible thumpers like myself, it's not a Fibonacci level. It is just a retracement, but it's a widely watched one. The 50% retracement, the 200 DMA, is going to offer a lot of support for bulls, for people that want to pick it up to the long side. Look, I'm a person that missed Bitcoin when it was down at 75,000. The brief couple hours that it spent sub 75,000, I'm kicking myself in the ass every day as a result, because I knew that was such a big level. I still think those are levels that you want to be a buyer, but I know there are hodlers that expect Bitcoin to eventually trade up towards 150 or 200,000. I am one of those people. I believe that Bitcoin will go higher over time, like gold. So, for those of you that are bulls, wait for this completion of the bearish chart pattern. And if you are Bitcoin is a tulip trader, meaning Bitcoin's going to eventually wither away and it's just a fad, then you got a bearish setup right now. You can play it on the short side down to about 94,000. So anyway, a little bit for the bulls.
It comes to my thesis. I mean, I couldn't tell you. I don't really watch difficulty ratings or mining hash rates and all those factors that you can get some really, really great on-chain data for for very little money, in the Bitcoin scene, which can be quite helpful. Although you need to be cognizant that you've got to try and make money out of a lot of information. But yeah, there's some really good information out there for people who look at those stuff. But for me, as a trading vehicle, I still think Bitcoin is absolutely brilliant. And I love it. So I think obviously it's open for longer, 7 days a week, and pay a little bit of a wider spread, but pay for the movement. So I just think it's a great market, and I like it long, like it short. I don't fall in love with the view; it just does what it does. And I couldn't tell you what's going to happen over the next 12 months, but I look at it here and now and what the market's selling me, and that's enough for me. But I think it's a great trading vehicle. Anyway, let's move on to play du jour. Okay, let's go Aussie dollar for me. Now, Aussie Kiwi is an interesting one. I haven't got that up now, but Aussie Kiwi, because Kiwi actually looks a bit better. It's been outperforming, and I think if you were to get a break, I haven't got the charts up, but 107.50 is the key level on Aussie Kiwi, and I think the difference here is similar to what we saw from the ECB last night. Is that they are getting closer towards an end point, and they may go on I think the RBNZ have been more aggressive than any other central bank, really. And they're getting very close to an end, whereas in Australia, we're getting started. So that is reflected in the rates market. It's reflected in the currency now. But, I think as well, we are seeing just an end point for rates relative to getting going. And that's reflected in Aussie Kiwi. Aussie dollar is obviously more a play on the US dollar side of things. And then, making a trade now ahead of payrolls, I think is tough. I don't want to do that because I don't know. I can't forecast payrolls. Could it have a move either side? Yes, absolutely. I want the market to show me before I come out and trade, because I don't want to necessarily go and trade this right now. I suspect, looking at that setup now with the short-term moving averages moving up, you're making a series of higher lows. It feels like this wants to break out to the upside, and you can see that this has been in a consolidation mode for quite some weeks. The longer that consolidation, the more powerful, and potentially the longer term the trend that comes through. But I like the way that you can feel that demand just bubbling up under the Aussie dollar here. The market wants to be long. We just need the green light to do it. And I want to de-risk the position, have a bit more conviction. I want to wait for payrolls to come out and just see if we do get that formal breakout, the close above this. I would then suspect there's a high probability that this could continue to kick and we could see a move going forward. But this is a one on the radar at the moment. Do I think it's going to go higher? Instinctively, I think it's going to happen. I don't have a position now, but I want one, and I'm waiting for the payrolls number to decide that.
Well, look at you. You and I, Chris, we're going to go hand in hand today, because I'm feeling a little dirty, and I'm going to tell you my play of the day is sterling. And I know people love to hate sterling, but let's not ignore the fact, and this is a 4-hour chart.
People hate sterling, do they?
People hate sterling. Go talk to your colleague Michael Brown. He's very certain.
He hates everything.
I think everybody in the UK hates the sterling, but we like to trade it. So I'm telling you, this thing's been holding out its breakout point, and it's 38% retracement above 134.50. Now 134.40 was the breakout point. It dipped as low as 134.20. That's the 38% retracement, pop right back up. This one, just like the Aussie, is set up beautifully for a weak jobs report. If we get a weak jobs report and the dollar gets hit, sterling's got a long way to go. I think it trades up towards 138 and beyond. It is a bull flag pattern. It is something that I'm not long, but I'm looking to get long. So not only am I going to be shorting the loonie potentially tomorrow, but I'm also going to be looking to get long sterling with a target of closer to 138. So, Chris, that is my feeling dirty play of the day.
Wait for the market to come to you. Let it increase the conviction levels with the price and the flows. Anyway, Blake, thank you very much. Obviously, keeping an eye on everything that's going on in markets. We're looking for that trigger. We're looking for the next catalyst that the market could be sticking its teeth into. We know there's a big shopping list of potential action items that we need to be sensitive to, including Musk, Trump, including the Senate, including what's going on around the tariff deadlines. It's all going on, but we want the market to reveal itself and show that it is a firm central focus. And then we can identify that, hopefully, on the trade-off. Anyway, Blake, thank you very much. Everyone at home, see you back next week for the trade-off.